if you look at what percentage AI will be of GDP, I don't think anyone disputes that it's going to continue to climb, not just from the infrastructure build out, like the maintenance and infrastructure side, but the OpEx side.
All right, joining me will be Will Rhind, founder and CEO of GraniteShares, who is now over $10.5 billion in assets. They have seen tremendous growth over the past several years. And here more recently, a significant driver of that growth has been their YieldBOOST lineup of ETFs. They now have 10 of these ETFs in all, and some of these are offering nearly 150% annualized distributions, 150%. Such as the GraniteShares YieldBOOST Coinbase ETF, ticker COYY. They also have a Tesla one that has 140% annualized distribution rate. And of course, with these types of payouts, that is going to catch the attention of investors. I would say especially retail investors. And so Will and I are going to have a full conversation around all of this. We'll go in depth on how these YieldBOOST ETFs work. We'll certainly talk about the risks involved with these products and whether Will has any concerns regarding retail investors getting their hands on these. And then we'll also get into some of the drivers behind the massive interest in options-based ETFs overall, which just continues to be one of the hottest ETF categories out there. Now to start, I am joined by Zeno Mercer, Senior Research Analyst at VettaFi, who I always say Zeno is our resident technology expert. And in particular, he's absolutely our artificial intelligence expert. And that's exactly what we're going to discuss, this entire AI theme, which I'll say AI ETFs are also a hot ETF category right now. But Zeno, it is great having you back on the podcast.
It's good to be here. I think this is our first video format version together. So this is fun to get this started off.
Well, and I was thinking about you because at some point down the road, this will all be AI, right? It won't be you and I. It'll be AI doing this podcast on our behalf.
Well, this is my avatar.
Well,
you wouldn't know if I had one or not, but it's really me. I'm here today, at least.
Well, look, I thought I would start with a very nice milestone for you and the team. I saw that the Robo Global Artificial Intelligence Index, which of course powers the ETF by the same name, ticker THNQ, the Think ETF, that recently crossed over $1.5 billion in linked assets globally. That's got to make you pretty happy.
Yeah, I mean, it's a lot to reflect upon, and it's been a journey since I got involved with the Think, construction of the index back in 2018. A lot has happened. I mean, we were categorizing what subsectors AI comprises of. Okay, there's the semiconductors, but okay, there's cloud. DeepMind had just been acquired a couple of years prior. Like a lot of chips were being created. A lot of the elements of AI were conceptually there. AI was just being really used by advertising and certain areas of connectivity, and it's a lot to reflect on. And in many ways we were a bit early. But yeah, as you said, we are now happy to have. And our partners are happy to have over 1.5 billion in AUM linked to the artificial intelligence strategy, which of course came after the robo strategy, which was the original robotics strategy in the world. So, yeah.
Yeah, and of course, interest around the Think Index and the ETF, that's reflective of growing interest in the AI theme overall. And I was looking this morning, I show the broader AI and big data thematic ETF category is taken in nearly $10 billion this year. $10 billion. And there are obviously several different ways you can slice and dice this category, right? I'm just looking at FactSet data, so you may have some different numbers. But I think the point is investors are clearly interested in AI. I'm curious, where do you think we're at in terms of demand for these ETFs? And it's funny because I always ask this question on crypto ETFs, and the answer is always that we're still early in investor adoption. Do you think that's the case with AI-themed ETFs?
Yeah, I mean, look, I hear a lot, and I've been guilty of this myself, of saying we're in the first inning, we're in the second inning, we're early innings, and that implies that we're in a game that has an end. And I think with AI, the way that we're looking at it is as like right now, I think everyone's focused on the capex cycle, data centers, and all that. And if you really think about it, if AI succeeds in disrupting all facets of the economy, from healthcare to logistics to manufacturing, it's going to have more of a physical embodiment. People talk about physical AI. And again, that's going to be more of an OPEX cycle, like an ongoing inference cycle. And so I think we will see at some point, a plateau of data center, at least CapEx, and we'll start to see an acceleration of these different parts of AI, right? So like robotics, autonomous vehicles, drones, they all are basically like little data centers on wheels or in the sky. They have to be connected. There's a lot of cybersecurity considerations. And of course, you have to manage it at scale. So right? Like right now, all this inference demand people are talking about is a lot of just like human to tech interaction. And it's going to be a lot of non human to tech and tech to tech interaction. And so I do want people to realize that there are a lot of underappreciated opportunities ahead that I don't think people are really focused on right now. And that's kind of where we come in, is like that's the area we've looked at before AI was even, I mean, not before AI was a thing, but before it was taking off with generative AI. Like the robotics angle of AI is actually also a big contributor and demand driver for the space. So, like, yeah, there are some big names out there, and some, like, maybe we'll get to it. Like, there have been some really big deals announced recently, references of like circular financing and things like that. And like, yeah, like I think there are certain companies that are more exposed to that, and others that haven't really gotten the appreciation yet.
But in terms of AI ETF adoption, it sounds like you still think we're fairly early.
Yeah, look, I think, if you look at what percentage AI will be of GDP, I don't think anyone disputes that it's going to improve, continue to climb, not just from the infrastructure build out, like the maintenance and infrastructure side, but the OPEX side. So I think there's a lot of runway. I mean, eventually, a lot of these SMIDs, small and mid cap names, and even like the smaller large cap names will be in more of the passive tracking large cap indices, but they would have missed a lot of the growth there on the way. So that's kind of how we see it right now. Is like, there is. I mean, if you look at like the cuts of where people have invested, like there's still a lot of people that don't have. I mean, we when we do our webinars, there are plenty of, and we have biased audience that are interested in AI. We still have many that have still not even put in like 1% allocation into AI as a specific theme. So yeah, I think there's still lots of runway left for the ETF as an AI theme, as a specific subsector. Yeah.
When I look at the flows into the AI ETF category, obviously a key driver in that interest, and this is a case for any ETF category, it tends to be performance. And so if I look at the Think ETF, that's up 31% year to date. And a number of other AI ETFs, they've seen pretty strong performance as well, which, by the way, that compares to about up 14% on the S&P 500. But I'm curious, when you look at what's actually driving that performance, and I know there's a lot here, but what would be some of the primary areas that you would point to?
Yeah, I mean, performance is based off relative valuations and expectations from, even let's say the beginning of the year, if we're going to look at kind of year to date performance. And, I think there were, often and many fears around like the durability and duration of this, and the longevity and how real it is. And clearly, even, going back to kind of when Trump got into office, there was Stargate, there was this like kind of heightened expectation, and the deep seat came and that dropped. And then the reality is, all throughout, we are seeing massive, in fact, one of the biggest data center and really like human capex cycles in history happening. And so I think people didn't really appreciate how real it was and what was at stake, that all of the major hyperscalers are going to increase their budgets. They're like, oh, okay, maybe it'll go up. But it's like, okay, no, like we keep increasing this 10 billion, 10 billion, 10 billion. Oh, now we're talking 100 billion, $1 trillion. And it's like, that's a number. No, it's like actually that's flowing in, and like these are planned capex from the semi equipment providers, from Taiwan Semiconductor to the actual servers in production themselves, from Meta and New Louisiana and Grok and XAI and Memphis. Like all of these things are real. Like these are tangible, but it's kind of hard to like digest that at first. So I think a lot of that has been tied to that, but a lot of this is just companies being in the right place at the right time and having invested. So a lot of this isn't just from semi. There's other players that have contributed strong performance, especially to think this year, and some of those have been even more recent rebalance additions. So the active research overlay to our strategy has provided actually significant alpha this year.
You alluded to valuations, and I know a recurring conversation that you and I always have around the AI category is valuations, which, by the way, I feel like I've covered this multiple times over the past several weeks on here as well. But I think you understand the concerns here, right? That valuations are overextended in general, and there's just a lot of froth in this space. Do you have any new thoughts around this, or are there any other concerns you have around the AI theme right now?
I mean, right now, I think it's been overly covered that AI is one of the strongest areas of the economy, and maybe in some ways propping up the economy. We have not yet seen like real true deflationary impact, and the reason I bring that up is it is going to lower the cost of many services. And the U.S. is a service-based economy. We have not been a production-based economy, so that has a lot of implications. And so a lot of existing big players will see, both benefit from, being able to synergy, restructure, but you're also going to see cost pressure too. So what are the companies and areas that have, strong pricing power? It's the ones that have the technical leadership to sell to these high demand areas, including the hyperscalers themselves. So, a lot of our highest growth and highest contributing performances here have been companies that provide goods and services to the hyperscalers build out. And so it doesn't matter if, let's say in 5-10 years, no one uses Windows because we've evolved to an LLM based new platform from another player. The build out and gains were there along the way. So like there is kind of like the picks and shovels theme is more resilient, especially as we're facing, increasingly high government debt, consumer debt. Interest rates lowering is good, especially for the robotics space. Actually, AI has been very resilient to interest rates. I mean, it's coming from the cash flow of very large companies. Robotics is a much more distributed purchasing base. So that's an area that to keep in mind. And valuations haven't really like swung back up for them, even though we're seeing the TAM like the addressable market and actually a lot of higher margin production and products coming on the line from both the AI and the robotics space. But that about going back to like valuations, I mean, the growth is justifying the valuations here. You are seeing continued upward revisions. In fact, just to make sure I get the numbers right, Q2 for Think saw 28% sales growth and 36% EPS growth on a weighted average basis. Over the last 90 days, we've seen EPS revised 8% upwards on a weighted average basis. And our top 10 holdings are just 25%. So when you look at it that way, there's a very distributed base of companies that are seeing strong performance and growth into kind of the more autonomous tech stack of the future.
Let me ask you this then, and I think you're hitting on this a little bit when you mentioned a strong base of companies out there. But if we go back to the ETFs, you and I have talked a lot in the past about getting exposure to the AI theme. And the conversation has been around the fact that there are plenty of investors who believe they have more than enough exposure if they already hold, say, an S&P 500 ETF, just because they have that exposure to the Mag 7. What is your case for looking beyond that? And again, we can put valuations aside if you want, or you can incorporate valuations here into that question. But what's the case in the AI theme for looking beyond the Mag 7?
Look, there's a lot priced into the Mag 7 right now. They've had a very strong second half of the year so far. I think you look at what companies benefit not only from these Mag 7 investments and are gaining steam, but like how does Nvidia get double or triple from here versus some of these players that are technical leaders that are smaller, like mid and smaller cap companies? Like let's look at Nebius, which we added in Q1. It's up 300% since we added it, which is kind of weird to say out loud, but it is up 309% since we added it. And part of that was due to a $17 billion deal with Microsoft. That's a lot more easy. That's a lot easier to swallow than OpenAI and Nvidia and Oracle's $100 billion type deals that are being discussed. Like Microsoft has the money; they're good for the money. So like, there's a lot more like resilience around these type of deals. And again, like when you're thinking about exposure, like what is the tech stack of the future? It's energy, robotics, and AI. And a lot of these companies are very underweight in the Mag Seven or even the VUs or Qs. In fact, I think Robo only has a 5% overlap with VU. And a lot of these companies like Ambarella, right now they're just $300 million revenue, but they just scored a new drone deal. There's autonomous vehicle deals. Like we're expecting more and more of these wins. It's easier for them and companies to take a bite and get them to $1 billion in revenue and 3x that than Nvidia is to continue to grow at the scale and rate it has been. So again, I think we need to start looking at and encouraging like where else is growth possible and what's plausible over the next 3 years and who has technical leadership to get them there.
In terms of where growth is possible moving forward. And by the way, I hope everybody can see your passion around AI and robotics just jumps off the screen. I've said that when we've done this podcast before.
No, now it's you can see the face.
That's right. And so I always love to ask you, what has you most excited about the AI theme moving forward from an investment perspective? So are there certain companies, certain technologies that you're seeing right now? Any other initiatives around AI that most have your attention?
Yeah. So to put it bluntly, it's physics. And that's not a company. That's just a theme. Performance per watt, performance per unit of energy. That's really important because we're seeing models get better and more capable, better benchmarks. That's open source and closed source. Okay. So open source meaning it's free, like you can just use it on your own server or even computer. We're seeing increasingly smaller models. They can run on iPhone 17 Pros. And we're going to start to see that distribution. So again, companies that are primed to take advantage of the power distribution and compute distribution, both in data centers and in robotics. So again, let's just break it down, physics. And this is atoms dancing to bits and bits dancing to atoms. And basically that means like we're going to see more and more of the world being controlled by bits that are on the cloud or even on device. That's physical movement and actuation. And so, I think we've been increasing exposure to areas that benefit from both, on both Robo and Think to that. So like, for example, Infineon analog devices help with signal processing and power management. Infineon is partnered with NVIDIA for their like Thor Jetson compute, so like robotics, and they're also helping with the 800 volt power delivery for their next generation of data centers. So and it's trading at I think 17, 18 times PE. So you have these companies that are like really good exposure, and yet you're just starting to see their growth wave come into effect. So I think that's where I'm really excited about is not just like how AI influences and impacts our lives. Like yesterday we saw OpenAI announce a partnership with Shopify and Etsy. You can now buy things on OpenAI. And so we're now going to have shopping agents. Like we're going to start to see the agentification and new platforms start to benefit us more. But like behind the hood, there's a lot of automation. And I think the exciting part is actually like what's enabling that behind the scenes, behind the hood or underneath the hood, more efficient economy, which we really need because again, we're in a lot of debt and we kind of need to like be a more efficient machine, more ROI per unit of dollar, per unit of energy. And we have a lot of energy demand coming up. So again, I would summarize it as the blending of physics in both the digital and physical realm as being the most exciting area right now.
I'm glad people like you understand this because a lot of this is way over my head. So I'm glad people like you are covering this. Before I let you go, I saw that you recently wrote a piece on Edge AI. This was at ETFtrends.com. Yeah. Do you want to explain that just at a high level?
Yeah, so a lot of the focus, again, this is kind of what I was just talking about, where it's a lot of compute. If you search something on ChatGPT, it's going to a cloud. Robots and drones and even ourselves will increasingly have more compute on the edge. And so just like a data center, there's power, there's heat, there's a lot of connectivity, cybersecurity considerations, but it's also even more complex because it's in the real world with an environment with sensors. A data center is this like central brain in a vat, very controlled, sophisticated, expensive brain. But at the edge, there's a lot of considerations, and the value of the edge, where AI can sense, analyze, and act. And that sense, analyze, act can be like digital, just like camera sensors changing traffic or communicating with autonomous vehicles. But also, it can mean, like as I said, sense, analyze, act, like a robot or a humanoid or something that is acting on behalf with an individual or in a manufacturing plant or logistics center. And so that edge AI is going to be the next big wave of AI investment, and really, it's where we start to see the real world impact skyrocket. And so, I really think people should start to think a little bit more about, and read that article about like what is the edge, what can it mean, what's the impact, and how could it even take away some of the demand from the need for data centers, because there is more distributed compute, as I was mentioning.
It's just amazing to me how fast the space is moving. It truly is mind-boggling. But Zeno, we'll have to leave it there. I always enjoy hearing your perspective on this. Like I said, you cover the space as closely as anyone. So certainly appreciate your insight, and thank you for joining me.
Appreciate you, Nate. Have a good one.
That was Zeno Mercer, Senior Research Analyst at VettaFi.
At Lazard Asset Management, we look beyond what the world sees today to help our clients achieve their unique financial goals. Our powerful suite of active ETFs reflects decades of experience from our specialized investment teams and a commitment to delivering results. Experience the power of active investing with Lazard. Visit lazardassetmanagement.com to learn more. The Lazard ETFs are distributed by Foresight Fund Services, LLC.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
I'm now joined by Will Rhind, founder and CEO of GraniteShares, who currently offers nearly 50 ETFs, over $10.5 billion in assets. And I'll tell you, GraniteShares is a unique issuer. So they offer everything from leveraged single stock ETFs to a popular physical gold ETF. They have a high income ETF, and they now offer what are called YieldBOOST ETFs, which is where we will be focusing our conversation. Will, it is always a pleasure. How have you been?
Being great. Thanks, Nate. And thanks for having me back. Good to see you.
Well, you as well. And it's funny because I was looking back and somehow it's been about 3 years since you last joined me on here. And here's a fun fact for you. Do you know what your assets were at GraniteShares back at that time?
I do not.
They were a little over $1 billion. So GraniteShares has like 10x'd over the past 3 years. So what's that ride been like?
Crazy. It does not feel like that in terms of the last time I saw it. It doesn't feel like that long ago, but that is wild if it really was over 3 years ago. And yeah, I mean, the company's experienced really some pretty dramatic growth, specifically over the last few years. And yeah, I mean, the number of products, the amount of assets that we're managing, the company's gone global. So some people may or may not be familiar with us, but we had or have a business in Europe. But in the last couple of years, we expanded into Asia and have a team of 3 people now based in Asia. So truly global now, which has been amazing to watch that grow.
Well, it's certainly been fun to watch from my perspective as well, because I always love true ETF success stories, and clearly GraniteShares is one. And so, look, a meaningful part of that success, at least here recently, has been these YieldBOOST ETFs. So I'm showing you currently offer 10 of these. You rolled out the first one in December of last year. That was a GraniteShares YieldBOOST Tesla ETF, ticker TSYY. And these cover everything from Coinbase to NVIDIA. You have a Bitcoin one. And so I thought a lot of questions here, but let's start with how these work. Do you want to explain what a YieldBOOST ETF does?
Sure. So essentially, YieldBOOST is our brand for options-based income ETFs, which have, I suppose, I don't want to say that they've become super popular just in the last couple of years, but I feel like we are talking about them a lot more than we used to. But covered call ETFs or options overwriting strategies have been around for a long time, and YieldBOOST is really just the latest expression of that. So, as you said, Nate, these are ETFs which sell a put option to generate income and then simultaneously buy a put option to provide some downside protection. So that's called a bullish put spread. And these are just simply options ETFs that are designed to generate very high yields or distributions. And we pay those on a weekly basis.
Yeah, I mentioned at the top of the podcast, for example, the Coinbase YieldBOOST ETF that has an annualized distribution rate of somewhere near 150%. The Tesla
That's
one,
right.
I think, is around 140%. And so, Will, I like to boil things down in layman's terms. So investors are pocketing the premiums from the selling of the put contracts. The upside is capped to whatever those premiums are, correct?
That's right. And which sounds kind of a funny concept that you're we're saying that it's capped to at 150% or whatever it may be. But that is indeed true.
Okay, and then on the downside, just to be clear, is there always a defensive position put on?
Always. That's just how we manage the strategy. So, like I said, it's a put spread strategy. And really, Nate, this wasn't a design improvement that we felt like we could improve on the covered call, the standard covered call strategy, which, as you know, has been around for a long time. And your standard covered call sells an option. In the case, it's a call option, but you get 100% exposure to the downside. So while you're collecting the premium from selling that option, you get all of the downside if the underlying goes down. So we felt like there was an improvement to be made there. We obviously sell puts. We think that's slightly more efficient, but we buy puts as well on the underlying, which does help provide downside protection.
And then the payouts or distributions, just to be clear, those are made weekly?
They're made weekly, yeah. So all YieldBOOST funds pay weekly.
Talk more about the impact of using 2x leveraged ETFs for the underlying exposure. So obviously those are more volatile, and because of that, the option premiums are going to be higher, which is why you're getting the quote unquote yield boost here. But what impact does the volatility drag or decay have, since the underlying exposure is those daily reset leveraged ETFs?
Yeah, so the good point here, or important point to make, is that YieldBOOST ETFs are not leveraged ETFs. Again, all we're doing is selling an option and buying an option. So at no point do we actually own or hold the underlying leveraged ETFs. It's just selling an option on an underlying asset, which in this case just so happens to be a leveraged ETF, and then buying a put option on that asset as well. So in terms of the actual performance of the ETF, the sort of daily rebalancing, if you will, has very little impact because of the weekly payouts. So you sell that option, at the beginning of the week, and then at the end of the week, the value of that underlying asset has gone up or down, which affects, the amount of premium that you generate. And I think the reason for doing this, and this is the secret sauce really behind YieldBOOST, is that if you were to sell a call option on a stock like Tesla, at any given time, Tesla has an implied volatility of, let's for argument's sake, say around 60 or 70. If you were to sell the exact same option on a 2x leveraged Tesla, then you would see an implied volatility of twice that, so around 140. So the implied volatility is an indicator of the net premium, the notional premium that you receive. And so the yield boost secret sauce is you get 2x the notional premium if it's an underlying 2x levered ETF. So it just takes the yield or the distribution up dramatically from where it would be on an unleveraged underlying. And that's really how you're able to generate some of those distribution numbers, whether it's 100, 150%, whatever it may be.
Yeah, very well said. I mean, the bottom line is that the more volatile the underlying, the greater the options premiums that you'll see on these. There has been a lot of discussion around the return of capital in some of these options-based ETF strategies that are out there, where in an effort to maintain the high distribution rates or yields, you'll see issuers are returning capital as well. And so ultimately you'll see NAV erosion. Is that happening at all with these yield boost ETFs?
It really depends what people are talking about. So I think when it's framed like that, Nate, unfortunately, this is where there's a lot of misinformation. And while I can't speak for every options-based strategy that is in the market, I'll tell you what we do for yield boost. And return of capital when it comes to yield boost is purely a tax construct. In other words, it's got nothing to do with the fund selling assets to try and maintain a certain distribution. It's purely the way that the distribution gets taxed. And that's sort of largely dependent on the performance for the week, whether the actual underlying is up or down. But it's purely a tax construct. And obviously, if you get return of capital in the context of a yield boost distribution, that's tax efficient. But just to be clear, it is absolutely not us over distributing. In other words, paying out more than the distribution that we receive from selling the option, which I think sometimes that's what people mean when they talk about return of capital, which, maybe there are targeted yield funds or things out there where, like you said, someone's trying to maintain a certain distribution of 10% per annum or whatever it may be. And if they don't hit that through the income generated through the fund, they then sell assets of the fund to sort of boost or prop up that distribution. And in the context of yield boost, certainly that is not what's going on. It's just a tax classification of the distribution that's received.
And on the note of taxation, and I want to be crystal clear here, we are not here to offer any sort of tax advice. I've got to say that. But how are the distributions from the yield boost ETFs typically taxed?
Yeah, so they're taxed as income, and then income less if there's any return of capital component. So return of capital is effectively not taxed, clearly from an income tax perspective, and it lowers the basis that you have in the investment. So it just depends on the amount or the contribution of return of capital. But let's say there's zero contribution from return of capital, then it would be taxed as income, just like any other income investment.
So in terms of use cases for the yield boost ETFs, Will, how are you seeing these being used in portfolios? Like, where do they fit?
Yeah, I think let's talk about portfolios first. I think we have gotten to a world where ETFs have become high precision instruments to deliver whatever outcome that people want. So I always say that, back in the day, people used to buy a mutual fund that promised them growth and income. And actually, in reality, it probably gave them very little growth and very little income. What the ETF market has done is really taken things like that and passed them into very precise instruments. So now you can get hyper growth investments, you can get moderate growth investments, and you can get moderate income and high income. And from that, it allows people to build portfolios that are much more precision driven than ever before. So put simply, if you add something that has super high yield into an income portfolio, you're going to increase the yield of that portfolio. And then depending on what the risk is, you can maintain either a slightly the same risk if it's an uncorrelated risk, or maybe increase the portfolio risk also, but the trade-off is you're increasing the amount of yield significantly. So it sort of depends on what people are trying to do. But we've been dealing with income-based portfolios for a number of years now. And typically where this fits in is advisors that have specific income portfolios for specific client set that need income. There's a very, very big premium, no pun intended, put on an instrument that generates a very high amount of income and pays on a weekly basis.
Well, and clearly there's significant interest here because the YieldBOOST ETF lineup, I show it's already over 600 million in assets. Again, you just launched the first one in December of last year. And as you know, this is reflective of a much broader trend in ETFs right now, where we are seeing this massive interest in options-based ETF strategies. I would say especially ones offering larger distributions. And maybe you touched on this in talking about portfolio application, but what do you think's been driving that interest just at a higher level?
Yeah, I think what's going on here, Nate, is this is a faction or a riff off of the FIRE movement that has been highly popularized on the internet. FIRE, just for those of you that are not familiar, stands for Financial Independence, Retire Early. And what we think is that there's a subset of that going on, whereby there's a group of investors, a large community of investors that are worried that they don't have an income source outside of their job. So most people in North America, the only guaranteed income source they have is their job. And people think their income is guaranteed until it's not. In other words, they lose their job or personal circumstances change. And so this is about building a secondary income source that is independent from your job. So again, a riff on FIRE, albeit this is not about retiring. This is about building financial independence through an alternative secondary income source. And I think what's interesting is that sits independently from long-term, financial planning through 401ks, et cetera, long-term retirement. This is just about, building alternative income, and through alternative income sources, something that yields very high weekly, or does very high weekly distributions like YieldBOOST, has been very much in demand. So I think what's going on here is much more of a movement around how to invest, what people are doing. And when we think about it in the context of building a reliable secondary income source that's not your job, I think that is really kind of where that YieldBOOST proposition sits.
When you mention that movement, have you seen, I would say, especially at the retail level, that there are these influencers out there and these YouTube channels that are built around options-based ETFs such as yours? Have you seen those out there?
I have, and I mean that's kind of what I'm referring to. Is that that's one expression of that, but it's all over the social media just more broadly, and I think people are actively talking about this in a much more open and transparent way than perhaps we did 20 years ago, etc. So there is this movement where people are actively trying to achieve different things in investing, and specifically when it comes to YieldBOOST or options-based ETFs, a lot of it is driven by this desire for financial independence through a genuine secondary income source that's not your job.
On the note of this FIRE crowd, or let's say the YouTube crowd that's out there, really retail investors. So I would say I could extend this question to any type of investor, but I'm sure you have seen some of the criticisms that are out there regarding these types of products, these options-based ETFs offering extremely high yields. And the criticisms are that investors don't fully appreciate all of the risks here. These products are too complicated for the average investor to understand, those sorts of criticisms. And obviously, I've known you for a long time. I know how GraniteShares operates. I know you've properly disclosed all the risks here. I also know that you're always willing to come out and do things like this podcast and try to educate the marketplace. You've always been about that. But what do you think about some of these criticisms?
I think a lot of it is misinformed. And again, it's sort of there's a group of people in the market, let's call them armchair commentators of the ETF industry, that cannot accept any construct of an ETF that is not just broad-based S&P 500, or maybe let's be generous and extend that to broad-based corporate or government bonds. And that's always just going to be out there. And again, that's what I love about ETFs, is that it's a true free market vehicle. And you are in control of what ETF you buy and hold, and what ETF that you don't buy. And so you can be as sort of plain Jane generic as you want, or you can get into much more complicated, excited strategies. You can be long term, you can be short term, and sort of everything in between. And so I think covered call ETFs or options based ETFs, like I said, this is not a new thing. This has been around for a long, long time. And options overwriting, covered calls, etc., whatever you want to call them, this is not something new. The only thing that's new, I think, is that self-directed investing is just becoming more popular. This is becoming, COVID really was the accelerant in this movement, where we see more and more money being managed on a self-directed basis, and therefore people having more and more interest in investing more broadly, and are looking for different expressions of product. And again, as it comes to the risk involved in products, I mean, every product has their own sort of risk return profile, and people should understand what that means and whether it's appropriate for them, and whether you take financial advice or whether you read up on the internet. People should understand what the product's designed for, and whether they're comfortable accepting that sort of risk. But nothing in this world comes without risk, and I think that's sometimes just not understood enough, that there's a lot of people that seem to think that certain amounts of, or certain investing styles come with no risk, and that's just not true. And everything in life is a balance between risk and reward.
Well, I think you hit on two key points there, things that I always talk about. The first one just being that the ETF industry, it is a meritocracy, and investors vote with their hard-earned dollars, and they decide which products they want to invest in. It's really that simple. And so,
absolutely,
yeah. So if you're seeing interest, for example, in these YieldBOOST ETFs, it's because there's real investor demand there. That demand's not fake. You can't make that up. And then the other point that I'll make on the risks, obviously from a regulatory perspective, you have to properly disclose all of the risks of any product that you're bringing to market. And I think it's important for ETF issuers to offer proper education, which you've done. But at the end of the day, investors and advisors, you can't divest your own personal responsibility. You have to do your homework.
Exactly.
And I just, that's something that I'm passionate about. I think that you want to get the education in the marketplace, but investors have to do their homework as well. It's really that simple.
Yeah, and look, and I would say the job's never done, right? We'll always be educating. For as long as we exist, we'll always be talking about what we do and how we do it. And as you say, at the end of the day, that doesn't devolve people from their own personal responsibility. And I think that's what's so great about a lot of the investment movement today, self-directed, everything online, is because people are doing a lot of research and ultimately becoming practitioners, even if it's the smallest amount. It still teaches you probably way more than you're ever going to get from a textbook. And so this is super important in terms of people learning about investing and ultimately acting based upon what's right for them.
All right. So moving forward, in full disclosure, I did not go out and check all of the SEC filings. So I'll just ask you here, should we expect additional YieldBOOST ETFs coming to market?
I probably sent you an email too late for the recording, but we just dropped 2 more today. So we launched YieldBOOST ETFs on Robinhood and SMCI. So again, 2 very popular stocks, particularly in the leveraged ETF world. And so those were SMYY for underlying SMCI, and then HOYY for the Robinhood derived one. So that extends the family. We did MTYY last week, which was based on MicroStrategy or strategy, and PLYY, Palantir. So continuing to roll out the offering of underlying YieldBOOST ETFs.
I love it. So the YieldBOOST ETF lineup growing in real time here on ETF Prime. Will, I always enjoy connecting congratulations on all the success GraniteShares is having. Again, I remember visiting with you when you first launched GraniteShares. So way back when, although it wasn't that long ago, and it's just so much fun seeing the growth you've had. So congratulations on that. Yeah, thank you for joining me.
Thank you, Nate. Always a pleasure to talk to you.
That was Will Rhind, founder and CEO of GraniteShares. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I will be joined by Amrita Nadakumar, president of Vident Asset Management. So we're going to go around the world of ETFs. And I'll tell you, if you haven't heard Amrita before, you're in for a real treat. She's truly one of the best all-around ETF resources out there. So certainly look forward to that. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.